Hi everyone, welcome to another video in my Intangible Assets Lecture Series. This video is going to be all about intangible asset amortization and impairment. So what am I talking about when I say amortization and impairment? Well, basically, these are ways that our intangibles can lose value from that original amount that we capitalize to them. So let's learn a little bit more about it. Okay, first up, amortization. It's a long word. What does it mean? Well, essentially, it is depreciation, but for intangibles. It's the spreading of intangible costs over time. And when we say over time, what we really mean is essentially over some sort of life. And I'm going to put a question mark and say life question mark, because life is not just one option in this case. I'll talk about that in a second. So here I have an example. This is from Alphabet's 10K. Alphabet is what used to be known as Google, right? Now Google is a kind of a sub-company of Alphabet. And this comes straight out of their notes to their financial statements. And it says, long-lived assets, goodwill, and other acquired intangible assets. And I just want you to kind of skip all this stuff and just scroll right down here to the bottom, where it says, intangible assets with definite lives are amortized over their estimated useful lives. Sounds just like depreciation, right? We amortize intangible assets on a straight line basis with definite lives, generally over periods ranging from 1 to 12 years. Now, here's the deal. They say in there that they amortize straight line for their intangibles. All companies have to go straight line for their intangibles. That is the way that intangibles are done, okay? So whereas depreciation, we have things like declining balance method and sum of years digits and all this other craziness that either accelerate your depreciation in some way or track it a different way other than evenly. For intangibles, it's just an even loss of value, so straight line over the useful life. Now Google says over the useful life, and you notice here they say 1 to 12 years. Keep in mind, intangible assets have two lives. They have the useful life, or what the company thinks they will use the asset for. They also have the legal life, and this is something I talked about in the video prior to this one, whereas patents last for 20 years, copyrights last for the life of the creator plus 70 years, trademarks last 20 years, but those could just be renewed indefinitely, right? So the legal protections have limits, and that's one life. On the other hand, you might have a patent on something that's going to last you 20 years, but that doesn't mean you're actually going to get use out of it for 20 years. Case in point, patents on the original iPhone. Y'all will find out. I love to use technology examples, right? And so I'll pick on Apple a lot just because I'm teaching you with Apple products right now, and that's just something I know pretty well. But the original iPhone came out in 2007. Had tons of patents on it, right? And so if you think about it, 20 years from 2007 puts us at 2027. That's still several years from now. I want you to think about the current iPhone and all the other technology of today. How much technology in the current iPhone is identical to the technology in the original iPhone? Now, they were both slabs of glass. They both have, aluminum body, depending on which model you get. They both run a software called iOS, though very different versions of it. But that original iPhone used a certain type of display panel. The new iPhones do not use that type of display panel. The original iPhone had a certain type of camera. The new iPhones have a much better camera. The first iPhone had certain processors in it. The new iPhones have better processors in it, and so forth and so on. There is very little, if any, technology from the first iPhone that is still in use in today's iPhone. So while the patents on that first iPhone are protected until 2027, Apple may not exactly be getting any value out of that first iPhone anymore. In fact, basically what I'm saying is its useful life to the company may have already run out, even though its legal life is still going. And so when it comes to amortization, as I say down here, you have to amortize straight line over the shorter of the useful life or the legal life. And if you think about it from an accounting standpoint, that makes sense. Amortizing removes the value from the asset. In other words, what was something that you put on your balance sheet that you say, this provides value to us, amortization lowers that value. And so if you were simply amortizing, say, over the legal life, even though its useful life is shorter, well, when the useful life of that thing runs out, you're still going to be putting value on your balance sheet, telling investors, hey, no, we have this thing of value. Well, how's it valuable if you're no longer using it, right? And so that's kind of the idea here is whichever one is shorter, whether it's the useful life or the legal life, that's the thing you need to amortize over. The example I just gave you was when useful life is shorter than legal life. What if it goes the other way? What if you get a patent on something that is just so cool that you know people will want it for 30, 40, 50 years? Let's just say that hypothetically could happen. When 20 years is up, every competitor you know can copy you identically. So sure, you might be able to use that asset for another 10, 20, 30 years over that 20-year useful life, 20-year legal life. But the fact is, once everyone can start copying you, chances are your product is going to plummet in value because you're not the only player in the market anymore, right? And so in that case, you wouldn't want to show this asset on your balance sheet with its full value after that legal life was up, even if you could use it longer. And so again, that goes back to this idea of let's be conservative about it. Let's make sure we're not over-reporting our assets. So you have to use the shorter of the legal or useful life when you amortize assets. All right, that brings us to impairment, right? So amortization is essentially depreciation for intangibles. What is impairment? Well, we've actually heard the word impairment before, never in this formality like this, but I have discussed it. I believe I might have discussed it when talking about perhaps inventory, if you go back and check that lecture series. But impairment is when one of your assets, due to some sort of changing condition, is lower in value than it used to be. It has been impaired is how we refer to that. And basically, this could happen to any asset. This could happen to your intangibles. It could happen to your inventory. It could happen to your PP&E. It could happen to anything. Anything could become impaired. But with something like intangible assets, testing for whether things have become impaired actually becomes much more important. And the reason for that is because we do have some intangible assets that have indefinite lives. In other words, there is no limit to the legal protection, and perhaps there's no legal limit to the usefulness of it to the company either, in which case it's not going to get amortized, right? Think about it. You amortize over the shorter of legal or useful life. Well, what if they're both infinity? What if there is no limit on the legal protection? What if there is no limit on the usefulness of the item? Well, then you're not going to amortize it. And so it'll just sit on your balance sheet at full value all the time. The question becomes, what if something shifts beyond your control that suddenly causes that thing to lose value? Should you leave it alone on the balance sheet, or should you decrease the value? Well, again, coming up with this kind of, accounting is pretty conservative in the U.S. Coming from that standpoint, if conditions say, hey, your asset lost value, you probably should mark it down. You should impair it to that value. And so what happens is if you determine that this is the case, you do engage in what's called a write-down of the value, where you literally credit the asset and bring its value down, and you debit some sort of expense to cover that. Give you an example of this in real life, because this is actually pretty interesting. Kraft Foods and H.J. Heinz, they were two separate companies prior to 2015. Kraft Foods, known for pantry items, staples, things like Kraft mac and cheese, Kraft cheese slices, that sort of thing, right? So, but these are highly processed foods that Kraft was pretty popular for. H.J. Heinz, known for things like condiments, ketchup, mustard, barbecue sauce, so forth and so on. Again, most of them pretty processed, not a lot of natural foods, things you find not in the refrigerated section, things you find in the middle aisles in the grocery store. These were two separate companies. In 2015, they merged together to form what's known as Kraft Heinz, and that merger cost $49 billion. Now, you can imagine there was some goodwill recorded as part of this merger, because it was thought of that, well, hey, you take one processed food company and you merge it with another processed food company, and now you've got the same company making two different things of processed foods that can be used hand in hand together to prepare people's plates, right? Give them a meal. You can imagine that there was definitely a sense of these two companies together are worth more than they are separately. And so when this $49 billion acquisition occurred, there was goodwill recorded. There was a lot of goodwill recorded. Well, here's what happened. This looked good at first until 2019. In 2019, Kraft Heinz, the combined company, started to realize that consumer preferences had really changed over the past few years. People weren't really big on processed foods anymore. People wanted natural. They wanted fresh, right? And so things like also under these brand names was Oscar Mayer, highly processed meat products. The company realized that people weren't as into that sort of thing anymore. And as a result, this combined company of two highly processed food products suddenly wasn't as valuable. And so what happened at that point? Well, they took a write-down. They wrote down both their goodwill. If you look in the caption over here, you see it says it was a $7.3 billion write-down of goodwill. And then they wrote down some other intangibles as well for a combined total of $15.4 billion. Now, take a look at that. It was a $50 billion deal, and they wrote down 15 of that 50. Only, 4 years later? That's pretty rough, right? And it wasn't because it was something that was within their control, at least not immediately. Consumer changes to a healthier lifestyle, those changes happen pretty quickly. And yes, while you could say, well, they should have changed as well. They shouldn't have been focused on processed foods, or at least they should have hedged their bets and had their foot in the door in some, less processed offerings. Sure, maybe so. We can all criticize after the fact. But the fact is, this is a huge write-down to take 15 out of $50 billion and just that value is wiped out off your books. And so this was huge when this hit the news. And as a result, the company's stock price dropped 27%. That's terrible, right? Go look at the stock market and look at any large company of this nature and tell me when you see their stock price move by 27% over a short period of time. It just rarely happens. Not unless there's some huge market thing that's moving the whole market like that. So anyway, dropped 27%. It brought the stock to an all-time low because at that point it was just like, oh, you guys are in trouble, right? And admittedly, so I'm using them as kind of the example here of where impairment really happens in real life, and investors do care about it because you're essentially just saying, hey, value that existed 1 minute, poof, gone the next. That doesn't sit well with investors. I'm using it as an example, but I do have to give them credit, at least as far as I have seen in my own personal life. They're trying to do better, or at least I don't know if doing better is the word. They're trying to adapt to consumers' new preferences. So, for instance, Kraft. They have this highly processed, not real cheese kind of mac and cheese product. They call it their Kraft Original Mac and Cheese. Well, the reason they have to call it their Original Mac and Cheese is because now they also have Kraft Deluxe Mac and Cheese, and the Deluxe is made with real cheese rather than whatever it is that they're using in the original, right? And so it's still a highly processed food. It's still not in the fresh food section of the store, but at least it to some extent was made with some real cheese, right? And even on the Heinz side, when you go look at the ketchup aisle, sure, you see all the regular Heinz there, and it's processed sugary ketchup, and we all love it. But you will also now see, I believe they call it Simply Heinz. It's still Heinz, but they put that Simply in front of it to kind of let you know, hey, you know what? This one isn't as processed. This one's more simple, right? And essentially, it's just supposed to be a closer to smashed tomatoes than the highly processed original Heinz. And I've actually had it. I think it tastes great, but it just goes to show you that companies do try to adapt, especially when an event like this happens, because there's no indication that consumer preferences are going to rebound back to processed foods. And so the merger of two highly processed food companies, they probably need to pivot into some less processed items at this point. And it seems like they're trying. Alrighty, so let's do an example. Here's an example of intangible asset amortization. I'm not going to do impairment. That is, again, we learn about it conceptually. I like you to know it exists. I like you to know that it's out there. But impairment is a little bit more nuanced in the details of the accounting, and so that is just better served in an intermediate or advanced financial accounting course rather than in an introductory course like this one. But we are going to talk about amortization, because amortization, now that we all know depreciation already, if you don't, you better go review my Fixed Assets Lecture Series, because we cover depreciation in great detail there. Amortization is just like depreciation. So if you can do one, you can do the other. This should be a breeze. So let's take a look at an example problem. On January 1st, FlyerCorp purchased a patent with a legal life of 20 years for $200,000. I'm just going to go ahead and kind of circle the important details as we go through it. So patent, 20 years, $200,000. FlyerCorp expects the patent to protect one of its technologies until obsolescence in 8 years. On May 1st, FlyerCorp filed a trademark for $10,000, so trademark $10,000. FlyerCorp does not intend to renew the trademark when it expires in 20 years. And finally, we got a lot going on in this problem. On June 1st, FlyerCorp paid $350,000 to acquire another company with a fair value of $300,000. Record any amortization journal entries required by FlyerCorp at its year-end, December 31. Whew, that's a lot. Now, notice I've given you 3 different intangibles up here. Patent, trademark, and then over here I didn't name it, but buying another company for greater than its fair value, that right there is goodwill. And specifically, because the company was worth $300,000, we paid $350,000. That's $50,000 worth of goodwill. So you've got 3 different intangibles here. And basically, the problem is not asking you to record the journal entries for the intangibles. You've got amounts. You know what the intangible is called. Debit the asset, credit cash. You're good to go there on journal entries. Instead, what it's asking you to do is figure out, how would the amortization journal entries look at year end? Now, first of all, we need to identify what up here gets amortized. Remember I told you that indefinite-lived assets don't get amortized. Why? Because they have no life to amortize over. So anything with a life gets amortized. Anything without a life does not. And so you've got a patent. This patent has both a legal life and an expected useful life. So it can be amortized. You have a trademark. Now, trademarks have a legal life of 20 years, but they could be renewed. And if the company intends to renew, technically that trademark could live forever. But in this case, it says the company does not intend to renew it. Therefore, this has a life, 20 years. And then you've got the goodwill. And I didn't mention it on the slide with Goodwill when I did that, when I covered it in the kind of intangible overview, but I'll say it here where it comes into play. Goodwill is not amortized, okay? So Goodwill is considered an indefinite life asset. You have this value unless you divest that other company that you acquired to create the value isn't going anywhere, and so it just sits on your books. All right, so we do not need to amortize the goodwill, so I'm going to scratch that one out. We do need to amortize our patent and our trademark. So you've got the patent at $200,000. Remember, straight line, so you simply take the value, divide by the life. That tells you how much to amortize per year. In this case, you've got the $200,000 patent divided by what life do we use? We've got a legal life of 20, we've got a useful life of 8. When it tells you that it's expected to protect one of its technologies until obsolescence in 8 years, well, at that point, it's not protecting anything, so it's no longer useful. So you've got 20 years, you've got 8 years. The rule of thumb is you must amortize over the shorter of the two, and so we are going to divide that $200,000 by 8. I believe that comes out to $25,000. So that is the annual amortization on the patent. Then we've got the trademark. So I'll do T equals, that trademark was $10,000. You don't intend to renew it when it expires in 20 years, so you've got 20 years until it runs out of value. So 10,000 divided by 20, I believe, comes out to 500. It's the annual amortization on that. From here, it's just a matter of constructing journal entries. So I didn't show you journal entries in this video, but that's because you didn't need them. Because if you can do depreciation and you know what those journal entries look like, you can do these journal entries. For fixed assets, when you depreciate something, you say debit depreciation expense, and then you credit accumulated depreciation dash whatever the name of the asset is. That's the general depreciation journal entry. Well, guess what? Amortization, replace the word depreciation expense with amortization expense, and replace accumulated depreciation dash asset with accumulated amortization dash whatever the asset is, and that is your journal entry. So if you know depreciation, you know amortization. And so I'm going to do a little bit of rearranging over here real quick. I'm going to take my patent, I'm just going to move it over here just to kind of scoot it out the way, and I'm going to move my journal entry. I'm going to start it up here, and I'm going to take this trademark and I'm going to move it too. So just to clean us up just a little bit. In this case, we actually have two assets that are amortizing. And so I've got accumulated amortization patent, accumulated amortization trademark. It is December 31st. And now it's just a matter of figuring out the amounts. And here's where I'm going to warn you if you overlook it. It is very easy for students at this point to say, well, the patent is depreciating by $25,000, the trademark is depreciating by $500, the total expense is $25,500, and we're done. That's a real easy mistake to make. Where's the mistake? Well, the patent was purchased on January 1st. It is now December 31st, and therefore you have had a full year of ownership of this patent. Therefore, you take a full year of annual amortization, and so that patent entry, that's okay. However, the trademark was filed on May 1st, and it is now December 31st. Yes, that trademark has $500 in annual amortization. However, it has only been, and here's where I pull out my fingers and I count. I know my video probably isn't on the screen right now, but we've had it for May, June, July, August, September, October, November, December. If my count is right, that is 8 months. So we've only had this for 8 out of 12 months. I'm going to bring out my calculator. All right, so I've got my 500 per year times 8 out of 12 months. That gives me $333. I'm just going to round it. Whoop, no decimal needed. And therefore, in my journal entry over here, I just have to adjust. And instead of 25,500, there's only 300 getting amortized to the trademark for a total of 25,333 as an amortization expense. And that is the journal entry for our amortization for the current year. Now, the next question I usually get from students at this point is, could I have done this as two separate journal entries? Do I have to combine it like this? Or could I have done the patent by itself? Could I have done the trademark by itself? And the answer is yes, absolutely. You could have split it up into two separate journal entries. One with amortization expense accumulated amortization for $25,000, one with amortization expense accumulated amortization for $333. You could have done two separate entries, totally fine. Hey, look at that. We're at the end of this video already. So again, I'm not talking about impairment, at least not the details of it. I'd like you to know about it. That's all. Impairment will come up again in your more advanced accounting classes, where you'll get into the nuances of how to deal with impairment, how to test for it, what you should record if things are impaired, so forth and so on. But as for now, we've covered the overview of intangibles. We've covered what you do as far as reducing the value of intangibles is concerned. And that's really it for intangibles. There's nothing else to really say about them. And so there is another video in this lecture series. But that video, now that we've hit the end of the asset section of the balance sheet as far as the order of these lectures goes, it's time for us to talk about doing some financial statement analysis on our assets. And so that's the topic of that video rather than intangibles. I hope you join me for it. I hope you found this one interesting, and have a great day.